If you asked an American in 1964 why the dimes and quarters in their pocket felt different than the ones minted in 1965, they would likely repeat the story told to them by the nightly news: there is a coin shortage. The government's official narrative was simple and seemingly logical. They claimed that coin collectors, vending machines, and a booming economy were sucking up small change faster than the mint could produce it. To save the commerce of the nation, President Lyndon B. Johnson announced a radical solution: the Coinage Act of 1965. This law replaced the 90% silver composition of dimes and quarters with a clad sandwich of copper and nickel, base metals with virtually no intrinsic value. It was sold as a practical logistical fix. But like many government narratives from the 1960s, it was a cover story designed to hide a much darker economic reality. The United States wasn't running out of coins, it was running out of money. The real reason silver was removed from our currency wasn't because of vending machines. It was because of a mathematical trap known as Gresham's law. This economic principle states that bad money drives out good. When a government forces two forms of currency to circulate at the same face value, but one is made of valuable metal and the other is made of cheap paper or base metal, the public will instinctively hoard the valuable one and spend the cheap one. In the early 1960s, the United States was walking into this exact trap. The US dollar was pegged to silver at a price of 1.29 per ounce. This meant that as long as the market price of silver stayed below 1.29, a silver dollar was worth more as a dollar than as a lump of metal. But the industrial world was waking up. The demand for silver in photography, electronics, and batteries was exploding, pushing the global price of the metal higher and higher. The US Treasury was in a panic. They knew that the moment the price of silver broke above 1.38 per ounce, the silver content in a quarter would be worth more than 25 cents. At that point, it would become profitable for every citizen to melt down their pocket change and sell the slag to a refinery. The nation's currency would literally vanish into the blast furnaces. To prevent this, the Treasury was frantically selling its own silver stockpiles to suppress the global price, keeping it artificially pinned at 129. But they were bleeding to death. They were losing millions of ounces a week trying to fight the free market. They realized that if they didn't demonetize the currency, if they didn't sever the link between the dollar and the metal, the US government would be completely drained of its strategic silver reserves within months. This context makes Lyndon B. Johnson's signing statement for the Coinage Act of 1965 one of the most cynical lies in presidential history. Standing before the cameras, LBJ held up the new copper-nickel coins, derisively nicknamed Johnson sandwiches by the public, and declared, "If anybody has any idea of hoarding our silver coins, let me say this. Treasury has a lot of silver on hand, and it can be, and it will be used to keep the price of silver in line with its value in our present silver coin. There will be no profit in holding them out of circulation for the value of their silver content." He was bluffing. The government did not have enough silver to hold the price down forever. In fact, just 3 years later, in 1968, the government abandoned the price peg entirely. The price of silver skyrocketed. Those who believed the president and spent their 1964 quarters lost 90% of their purchasing power. Those who ignored the president, hoarded the silver and melted it down, or simply held it, made a massive profit. The coin shortage was the excuse. The default on the silver standard was the reality. 1964 marked the year the US dollar completed its transition from a store of value to a pure instrument of debt. The silver coin was the last check on the government's ability to inflate the currency, and in 1965, they removed the check. To comprehend the sheer magnitude of the heist that occurred in 1965, one must look beyond the coins themselves and understand the global economic chessboard on which the United States was losing. The removal of silver was not an isolated administrative decision. It was the inevitable collapse of a price-fixing scheme that the U.S. Treasury had been running for decades. By pegging the price of silver to 129 per ounce, the United States was effectively subsidizing the rest of the world. It was a reverse corner on the market. In a normal market, a monopoly tries to push prices up to gouge consumers. In this case, the U.S. government, which held the largest stockpile of silver in history, was using its monopoly power to push prices down. Why would a government deliberately sell its own strategic assets for less than they were worth? The answer lies in the illusion of stability. The dollar's credibility rested on the promise that it was as good as gold internationally and as good as silver domestically. If the price of silver rose, it would signal that the dollar was losing purchasing power. It would reveal the inflation that the Federal Reserve was creating to fund the burgeoning welfare state of the Great Society and the escalating war in Vietnam. To hide the inflation, they had to suppress the thermometer. They had to keep silver cheap. This policy created a perverse incentive structure that bled the national vaults dry. By capping the price at $1.29, the U.S. Treasury told the world, We will sell you silver at this price, no matter how much you want. Who took advantage of this? Everyone. Industrial giants, companies like Eastman Kodak, which consumed massive amounts of silver for photographic film, were effectively receiving corporate welfare. They could buy silver from the Treasury at the fixed low rate, while the true market demand was much higher. Foreign nations. Other countries exchanged their paper dollars for U.S. silver bullion, draining American vaults to build their own reserves. Speculators, savvy investors saw the math. They knew the U.S. stockpile was finite. They borrowed dollars, bought silver at $1.29, and simply waited for the Treasury to run out. It was a risk-free trade. The scale of the drain was staggering. In the late 1950s, the U.S. Treasury held over 2 billion ounces of silver. By 1965, that stockpile had plummeted to dangerously low levels. The run on the Treasury was underway. Every day, trucks were leaving the West Point Depository loaded with bars of silver that would never return. The government was liquidating the family's silver to pay for the credit card bill of the Vietnam War. If they hadn't demonetized the coinage in 1965, the Treasury would have hit zero. If they hit zero, the dollar would have collapsed. Because the silver certificates in circulation, the blue seal and red seal notes discussed previously, would have defaulted. The Coinage Act of 1965 was the emergency brake. It was the government saying, we are reneging on our debts because we can't afford to pay them in metal anymore. This betrayal was codified in June 1968, 3 years after the coin switch. This was the final deadline for Americans to exchange their silver certificates for actual silver bullion. For decades, a $1 silver certificate promised the bearer $1 in silver. After June 24, 1968, that promise was null and void. The certificate became a Federal Reserve note in all but name, a piece of paper backed by nothing but faith. People lined up around the block at the assay offices in San Francisco and New York in the final days, desperate to trade their paper for small pouches of silver granules, since the Treasury had run out of bars and coins. Those who missed the deadline were left holding paper souvenirs. Those who got the metal saw its value explode. By 1980, the silver that the government claimed was worth $129 was trading at $50 or more. The citizens who trusted the government's money lost 97% of their value relative to the metal. The citizens who hoarded preserved their wealth. This transition fundamentally altered the psychology of the American consumer. Before 1965, saving money meant literally hoarding coins. A jar of quarters was a jar of silver. It was a store of value that was immune to inflation. You didn't need a bank account or a stockbroker to preserve wealth. You just needed a piggy bank. After 1965, saving coins became an act of stupidity. The new clad coins were made of copper and nickel, metals so abundant that they offered no protection against inflation. This forced the middle class into the financial system. If you couldn't save in money, you had to save in products of the financial system, savings accounts, bonds, stocks. You were forced to give your capital to the banks so they could lend it out. You could no longer be your own central bank. This was the financialization of the American household. It turned a nation of independent savers into a nation of dependent investors, forced to chase yield in the stock market just to keep up with the cost of living. Furthermore, the debasement of the coinage was a prerequisite for the inflation of the 1970s. You cannot have double-digit inflation if your money is made of silver. If the government prints too much paper money while coins are silver, Gresham's law kicks in immediately, the coins disappear, and the economy stalls. By removing the silver, the government removed the circuit breaker. They cleared the path for the Federal Reserve to expand the money supply without any physical constraint. The great inflation that ravaged the U.S. economy from 1971 to 1981, where prices tripled and interest rates hit 20%, was only possible because the link to silver had been severed in 1965. Lyndon Johnson's sandwich coins were the seeds of the economic stagflation that destroyed the middle class a decade later. They blamed OPEC, they blamed unions, they blamed greed. But the mathematical culprit was the removal of the tangible anchor from the currency. The villainy of this move is compounded by the fact that the government knew exactly what it was doing. Internal memos from the Treasury Department at the time show that officials were terrified of the public waking up to the swindle. They launched massive propaganda campaigns to discourage hoarding. They accused collectors of being unpatriotic. They even considered laws to ban the melting of coins, which they eventually passed. They tried to criminalize the act of protecting oneself from inflation. They wanted the public to continue treating the copper slug as if it were a silver treasure, while the government quietly sold off the real treasure to industrial buyers. It was a transfer of wealth from the little guy, who held coins, to the big guy, who bought the bullion. The Coinage Act of 1965 was not a logistical fix, it was a default. It was the United States declaring bankruptcy on the installment plan. And the 1964 Kennedy half dollar, the last true silver coin minted for circulation, remains a tombstone for the era of honest money. The ghost of the Coinage Act of 1965 is not merely a historical specter, it is a living economic reality that dictates the price of everything you buy today. To understand the true cost of the demonetization of silver, you simply have to perform a basic act of financial archaeology. Take a 1964 Washington quarter. In 1964, this coin was legal tender for 25 cents. At that time, 25 cents could buy you a gallon of gasoline. Today, in 2026, if you take that same 1964 quarter to a coin dealer or refinery, they will pay you roughly $5 for the silver content inside it. Guess what a gallon of gas costs today? Roughly $5. The price of gas hasn't actually changed in 60 years. In terms of silver, gas costs exactly the same amount of labor and capital to produce and distribute as it did when LBJ was president. The only thing that changed is the currency used to measure it. The clad quarter, the copper-nickel slug in your pocket, has lost 95% of its value. The silver quarter has preserved 100% of its purchasing power. This simple experiment shatters the illusion of inflation. Prices aren't going up, the dollar is going down. The removal of silver was the removal of the truth. It broke the thermometer so the government could heat up the room without anyone proving it. We are currently standing on the precipice of a second 1965. The forces of Gresham's law are once again attacking the U.S. coinage, but this time the target is not silver, it is copper and nickel. Just as the silver in a dime became too valuable to circulate in 1964, the copper and nickel in our modern 5-cent piece are now worth more than 5 cents. The amount value of a standard U.S. nickel often fluctuates above 0.06 or 0.07 depending on commodity prices. This means the U.S. Mint is losing money on every single nickel it produces. This is known as negative seigniorage. It is the death rattle of a currency. When it costs the government 7 cents to print 5 cents, the system is mathematically broken. History tells us exactly what will happen next. The government will eventually debase the nickel. They will switch the composition to cheap steel or zinc, just as they switched the penny from copper to zinc in 1982. And when they make that announcement, the old nickels will instantly disappear from circulation. They will be hoarded by the millions by those who understand Gresham's law. They will become the poor man's silver. We are watching the same movie again, just with cheaper actors. The cycle of debasement does not stop until the money is worth absolutely zero. This inevitable slide toward worthlessness explains the explosive rise in popularity of constitutional silver, often erroneously called junk silver. These are the pre-1965 dimes, quarters, and half dollars that were pulled from circulation. For decades, they were treated as scrap metal tossed in buckets at coin shops. Today, they are becoming a primary survival currency for the sovereign individual. Why? Because they possess a unique quality that modern bullion does not: transactional utility. The demonetization of 1965 also laid the psychological groundwork for the cashless society. Once the public accepted that money had no physical value, that it was just a token of state power, the transition to digital money became inevitable. If a coin is just a worthless slug of copper, why carry it? Why not just use a plastic card? Why not just use a phone app? The physical burden of heavy money was removed, but so was the privacy and autonomy of physical ownership. The final step of this process is the central bank digital currency, CBDC. The Coinage Act of 1965 removed the soul of the money, the silver. The CBDC removes the body of the money, the cash. It completes the transformation of the citizen from a bearer of assets to a user of credit. In 1964, if you had a silver dollar, you had wealth that the government could not turn off. It was yours. In 2026, if you have a digital dollar in a CBDC wallet, you have a privilege that can be revoked if you violate a carbon quota or a social credit score. The road to digital serfdom began when they took the silver out of the coins. It conditioned us to believe that money is whatever the government says it is, rather than what the market proves it is. However, the silver market is coiling for a revenge event that could make 1964 look like a minor blip. For 60 years, the price of silver has been manipulated through the paper markets, COMEX, where billions of ounces of virtual silver are traded to suppress the price of the physical metal. This suppression allows the government and industry to maintain the illusion that the dollar is strong. But the geology is fighting back. Silver is a strategic metal. It is essential for solar panels, electric vehicles, and cruise missiles. We are consuming silver faster than we can mine it. Above-ground stockpiles are draining. We are approaching a physical shortage, a real one, not a fake coin shortage, like in 1964. When the industrial users, Tesla, Samsung, Raytheon, cannot get the physical metal they need to build their products, the paper price manipulation will fail. The price will have to reset to a level that balances physical supply and demand. Some analysts predict this could result in triple-digit silver prices, $100, $200 or more. If that happens, the 1964 quarter won't just be a store of value, it will be the best performing asset in your portfolio. It is the ultimate asymmetric bet. Limited downside, it's always worth at least face value, and unlimited upside as the dollar collapses. The lesson of 1965 is that governments will always choose to default on their promises rather than face the discipline of the market. They promised the silver certificate was redeemable. They lied. They promised the new coins were just as good. They lied. They promised they would keep the price of silver down. They failed. They are making promises today about the safety of the banking system, the transitory nature of inflation, and the solvency of Social Security. History suggests you should treat these promises with the same skepticism as a 1965 Johnson sandwich. Do not wait for the government to announce a reform. By the time they announce it, the wealth transfer has already happened. The silver window closed in 1968. The gold window closed in 1971. The next window to close will be the exit window from the dollar itself. Those who hold physical assets, whether it's the silver quarters of the past or the decentralized assets of the future, are the only ones who are listening to the signal amidst the noise. The Coinage Act of 1965 was the crime. The inflation of the last 60 years was the getaway. And you are the one paying for it, unless you opt out.